Have you ever, looked at all the market information swirling around? I mean, the news, charts, opinions, it's just constant. And you just wish you could cut through all that noise, get to what really matters, understand the pulse without getting totally swamped. Well, today we're doing a deep dive into something that might just help. The dual nature of price. It's a concept from Sir Margin based on the sources we looked at. And that price you see flickering on the screen, it's actually, well, it's more than just a number. It holds these two identities, part history, part living psychology. Our mission today is to unpack why getting this dual nature is frankly crucial. It's not just theory. It really matters if you're trying to navigate complex info, especially, with market decisions. So let's dig in and see how these two sides, which seem maybe contradictory, can actually work for you. Okay, so first off, when you glance at any market chart, like any point on it, that price, it's basically a historical record. It's proof of a transaction that it already happened, it's done. And Sir Margin makes a really sharp point here. Relying only on that past data without understanding the context behind it, that can be a huge weakness. He calls it an Achilles heel.
That's a great way to put it. It's like looking at yesterday's weather report to decide if you need an umbrella today. You know, completely ignoring the dark clouds gathering right now. Markets aren't just simple repeating patterns.
Right.
They're driven by real stuff, events, economic data, shifts in how everyone's feeling, sentiment.
Exactly. But then there's the other side of the coin.
Precisely. While it is history, price action is also this footprint. A footprint of collective market psychology. It shows the combined decisions, the fears, the greed of millions of people, all reacting to all the information they know right at that moment. Think about it from the technical analysis side. They argue that all the fundamental stuff, news, earnings, data set, it gets digested by the market super quickly. And then it's reflected almost immediately in the price. So when you analyze price, you're kind of indirectly analyzing how the market feels about those fundamentals.
Okay, so one foot in the past, the cold, hard data, and the other foot right in the messy, emotional present. It really does sound like a contradiction, like you have to pick one view. How do they both exist at once?
Well, that's the fascinating part, isn't it? They aren't really contradictory. They're two facets of the same thing. And understanding that leads us straight into how people actually try to analyze markets. Different approaches, different lenses.
Right. Let's break that down. We can start with fundamental analysis. Sir Margin describes this as focusing on the why. It's about studying the events that led to price being printed. So you're digging into an asset's real value, looking at economics, financials, all that qualitative, quantitative stuff. It's basically trying to answer, why is the market doing what it's doing? Why is the stock going up? Or why is this currency falling?
Yeah, the deep-seated reasons. And then you have price action analysis, which is, a big part of technical analysis. And this approach, it really doesn't care much about the why, not directly anyway. Instead, it's laser-focused on the what, where, and when.
Okay, like what specifically?
Well, what is the price doing right now? Is it trending up, down, or just chopping sideways? Then, where are the important spots? Things like support and resistance levels, those prices where buyers or sellers tended to jump in before. Key decision zones?
Gotcha.
And maybe most practically, when is a good time? When should you maybe manage your risk or get into a trade or get out? Timing.
So fundamentals for the why, price action for the what, where, when. Okay.
Yeah.
It makes sense why someone might just, grab onto one of those and ignore the other. I know when I was starting out, I got so hung up on finding the perfect chart pattern. Totally missed a huge interest rate decision coming up. Whoops.
Ouch. Yeah, that sounds familiar.
My portfolio felt that one. And that's exactly Sir Margin's Achilles heel, right? Just looking at the pattern, ignoring the why.
Absolutely. And the sources are really clear on this.
Yeah.
Relying on just one approach in isolation is risky.
Yeah, following patterns blindly without knowing the fundamental backdrop. That feels like walking on thin ice.
It really is. You could buy into what looks like a great setup right before some major news blows it out of the water.
And the flip side is risky too, isn't it?
Definitely. Just knowing a company is fundamentally solid doesn't tell you the best time to buy the stock, especially if the whole market's in a panic. You might buy something good and still watch it drop 20% because of fear or, broader sentiment, even if the long-term picture is fine.
Right. Timing matters.
It's so tempting to just pick a lane, fundamental or technical. But the sources really push towards a more, integrated strategy.
And this is where it gets really interesting, right? Connecting these ideas. Sir Margin shows how the most robust strategies don't see these as enemies. They don't make you choose. Instead, they weave them together, use both lenses.
Exactly. If we step back and look at the bigger picture here, it totally shifts how you process market information. The sources suggest using fundamental analysis mainly to form your initial bias.
Bias, like your
Yeah.
overall direction.
Yeah, exactly. You figure out what you want to trade and, crucially, which way you think it's likely to go. So, for example, if all the economic data you're looking at points to, say, the euro likely strengthening against the dollar, your fundamental bias is now bullish on the euro. You're looking for chances to buy it. You've got your target, you've got your direction.
Okay, so the why gives you the direction,
Yeah.
and then price action comes in.
Precisely. Once that fundamental bias is set, where you want to go, then you use price action for the actual execution and, importantly, managing the risk.
Ah, so it's about timing the entry and exit.
Right. You wouldn't just blindly jump in the moment your research says buy. No, you'd use price action. Maybe wait for the price to pull back to a key support level you identified, or look for a specific bullish pattern to confirm the timing.
Okay.
And critically, price action helps you define your risk. You can pinpoint a logical place to put your stop-loss order.
Right, the safety net.
Yeah, just below a clear support structure, for example. It protects your capital if you're wrong about the timing or the immediate move.
So it prevents you from just, like, guessing.
It's the synergy. That's the key takeaway. In this kind of integrated model, price action isn't making the decision for you. It becomes a tool. A powerful tool, yes, but a tool to execute a trade based on that fundamental reasoning.
So you avoid buying just because it looks cheap on a chart or selling because it looks expensive.
Exactly. Without considering the actual momentum, the market structure, what the price is doing, it combines the why with the what, where, and when.
That makes so much sense. And it brings us right back around to Sir Margin's main point, doesn't it? Using price action alone, in a vacuum, that's setting yourself up for failure. That's where it becomes the Achilles heel. It distracts you from the real reasons, the fundamentals driving things.
But, and this is the crucial but, when you integrate it. When you use price action as that specific tool for timing and risk management within your broader, fundamentally informed view, then it becomes incredibly valuable. An indispensable part, really, of a successful approach to understanding what's happening in the markets.
Yeah, absolutely. And this idea, this dual perspective, history plus psychology, it feels bigger than just trading, doesn't it? I mean, think about it. How could recognizing this kind of dual nature in other types of data help you? How could it help you make better decisions, maybe in your work or just life in general, way beyond finance? Something to think about.